Hi, my name is Bonnie Gilbert. I'm with Fairway Independent Mortgage Corp, and I'm a reverse mortgage specialist. And I want to take a few minutes to talk about what is the difference between a traditional home equity line of credit, or a HELOC, and a reverse mortgage line of credit. There's some very basic and important differences. Both of those liens will allow you to tap into equity in your current home, in your primary residence. How do they differ? Well, one thing is that you might be thinking, well, a home equity line of credit is easier to get. I can go to my local bank, they'll set me up, the cost may be lower, and that's all true. However, here are some very big differences. Most people don't realize that with a traditional line of credit, a HELOC, the bank can call back whatever you owe them whenever they want. They can freeze the line, or they can reduce the line available. Now, you might be thinking, well, what does that all mean for me? And why would they bother to do that? Well, we have seen these situations in the last 10 years where they might do it because the real estate market has changed. Maybe the value of your home has gone down. We all remember about 12 years ago when values dropped, people who owed money on their line of credit were getting calls from their banks telling them that they needed to pay down the line, or that the line was being frozen, they weren't able to borrow anymore, or that the line was being canceled, or the whole amount was being called. This not only happens when the real estate market changes, but it can also happen when your financial situation changes. For instance, if you qualified for that line of credit when both you and your spouse were working, that's fine, but what if you both retire and now your income has dropped, or unfortunately one of you has passed away? The other person might not qualify any longer on their line for that line of credit. Okay, so those are some of the things that can change, but are those the critical factors? Maybe not. Here are some other important factors that differ with a traditional line of credit and a reverse mortgage line of credit. A traditional line of credit requires monthly payments, just like a traditional mortgage. Yes, it may be interest only, and we've all gotten really comfortable with lower interest rates and thinking, oh, I can afford the interest only on $100,000 because it's only 3%. I can afford that. Well, it's a variable rate mortgage, the line of credit, and as interest rates go up, so will your monthly payment, and it's only going to be requiring interest only. So that means you still owe all this money in 10 years. Let's say you've borrowed out $100,000 to do a major renovation. You're only paying a few $100s a month now. Maybe you're only 65 years old and still working. What is that payment going to look like when you're 75? You haven't paid down the principal and interest rates are much higher, and you're living off a more constrained income. All right, so now I've told you all about the traditional lines of credit, and maybe you knew all of those things and weren't thinking about it quite that way. How does a reverse mortgage work any better? A reverse mortgage is significantly different in that, one, it can never be called. It can never be frozen. It can never be reduced. Whatever that line of credit starts, whatever number it starts with, whether it's $100,000 or $300,000, that's the line of credit made available to you, period. If on day one. If you borrow money out, of course it's going to go down. But you are never required to make a payment. You are never required to make an interest payment or a principal payment. If you borrow the money out and you put it back in, that money becomes available again. All of the money that you pay in becomes available, not just principal payments. And last and most interesting, and what most people don't know, and I saved it for last because it is a unique feature to the reverse mortgage line of credit, FHA will, in essence, reward you for leaving money in the line of credit. Well, how will they do that? they will add a little bit more every single month, every single year to what is being made available to you. What do I mean? That is so confusing sounding. However, think about it as working in a manner similar to a savings account. It is not a savings account. You are not earning interest that you are entitled to regardless of what happens to your house. Okay, it's a little bit different. But let's just use an example. If you start off on day one with a line of credit of $100,000 and you don't need to use it at all, you set it up when you're 62 or 65 just so that the money is there in case you need it, and you don't need it, so you let it sit. So a year later, you will have more than $100,000 there available to you. They will add a little bit more equity. They will look at interest rates, and let's say the interest rate for the previous year had been 3%. They will add 3% more equity to your equity line of credit. So, what does that sound like? So if you start off with $100,000 and you haven't touched it, a year later you'll have $103,000. And a year after that you'll have 106 plus, because it compounds on itself. So you have more than another $3,000. And then the year after that, maybe now you're at $110,000. Well, that year you decide, okay, this is it. I really want to tap into some of that money. So we're going to go on a big trip. I'm taking the family on a big trip to Disney World. And so you take out $10,000. You're back to $100,000. Now you owe the $10,000, but that $100,000, it's going to grow again. The next year again, you'll have 103. And if interest rates go up, you'll have even more than the 103. And if you brought it all the way down, you did a renovation on your home and you brought it all the way down to 50,000, yes, you now owe that 50,000, and maybe you still owe the money from the Disney World trip. Yes, all of that is true. But the 50,000 that's still sitting there, that's going to go back to growing again. That is a unique feature to a reverse mortgage. And when you take some time to look at some tables to see what that growth can do for you and for your financial security in your home, it is quite significant. And it's the kinds of things that I talk with financial advisors and borrowers about all the time, and it's something for you to be considering.